Hey guys, let's talk about investing. Whether you're just starting out or have been investing for a while, understanding how to manage risk is one of the most important skills you can develop. Investing is like a roller coaster. It has its ups and downs. Sometimes the ride is thrilling, and other times it can feel a bit scary, especially when markets are unpredictable. But with the right strategies, we can enjoy the ride and reach our financial goals. Smart investors know how to prepare for the unexpected, so they can celebrate their wins and learn from their losses. Just like we wear helmets for safety, we need risk management in investing. It acts as our financial safety gear, helping us avoid big setbacks. Risk management is about protecting our money from potential losses. It's about being proactive, not just reactive, so we're ready for whatever the market throws at us. It's about making smart choices to minimize risks while aiming for good returns. This could mean diversifying your investments, setting stop-loss orders, or regularly reviewing your portfolio. Investing always involves some level of risk. No matter how careful we are, there's always a chance things won't go as planned. This means the value of our investments can go up or down. Markets can change quickly, and sometimes for reasons we can't predict. Understanding and managing these risks is crucial for successful investing. It helps us stay calm during market swings and make decisions based on logic, not emotion. By implementing effective risk management techniques, we can safeguard our investments and increase our chances of achieving our financial objectives. This means we're not just hoping for the best, we're planning for it. Remember, risk and reward often go hand in hand. The more risk you take, the greater your potential for reward, but also for loss. Higher potential returns usually come with higher risks. That's why it's important to understand your own comfort level and financial situation before making big decisions. That's why it's essential to find the right balance between risk and reward based on our individual financial goals, risk tolerance, and investment timeline. With the right approach, risk management becomes your best friend on the journey to financial success. Now, let's talk about market crashes. These events are some of the most dramatic moments in the world of investing, and they can have a huge impact on both individual investors and the global economy. Imagine a sudden steep drop in stock prices, almost like a roller coaster plunging downwards without warning. That's what we call a market crash, a rapid and often unexpected fall in the value of stocks. It's when the overall market experiences a significant decline in a very short period, sometimes just days or even hours. This can lead to panic selling and widespread uncertainty. These crashes can be triggered by a variety of factors, such as economic recessions, global pandemics, sudden changes in government policy, or even unexpected geopolitical events. Sometimes, a combination of these factors can make the situation even worse. Market crashes can be unsettling and even frightening for investors, especially those new to the market. But it's important to remember that crashes are a normal part of the economic cycle and have happened many times throughout history. While they can be nerve-wracking, market crashes also present unique opportunities for savvy investors who are prepared to act. Some of the best investment opportunities arise during these turbulent times. By understanding how market crashes work and having a solid risk management plan in place, we can navigate these challenging periods and potentially benefit from the eventual market recovery. Don't let the fear of market crashes scare you away from investing altogether. Instead, use them as a chance to learn, grow, and build your confidence as an investor. Remember, every market downturn is also an opportunity to refine your investment strategies, gain valuable experience, and prepare for future success in the world of investing. One of the simplest yet most effective risk management strategies is diversification. Think of it like this. Instead of putting all your money into one stock, you spread it across different investments. This is like having a variety of fruits in your basket. If one goes bad, you still have others. Diversification involves investing in a mix of asset classes, such as stocks, bonds, and real estate. Within each asset class, we can further diversify by investing in different sectors and industries. By diversifying our portfolio, we reduce the impact of any single investment on our overall returns. Remember, diversification is not about eliminating risk entirely. but about spreading it out. It's a key strategy for building a resilient investment portfolio that can withstand market fluctuations. Imagine setting a safety net for your investments. That's what stop-loss orders do. They automatically sell your investment if the price drops to a certain level, limiting your potential losses. It's like having a guardian angel watching over your investments. Stop-loss orders are essential for managing risk, especially in volatile markets. They help us stay disciplined and avoid making emotional decisions when market sentiment is low. By setting stop-loss orders, we can protect our capital and prevent small losses from turning into significant ones. Remember, the key to using stop-loss orders effectively is to set them at realistic levels. Set them too tight, and you risk selling your investments prematurely. Set them too loose, and they may not provide adequate protection. Before putting our hard-earned money into any investment, we need to understand what we're getting into. Research is crucial. It's kind of like checking the weather forecast before going on a hike. It helps us prepare for what's ahead. So start by understanding the basics of investing, the different asset classes, and various investment strategies. Also, make sure to learn about the companies or assets you're considering investing in. Take a look at their financials, try to understand their business models, and assess their growth potential. Remember, knowledge is power when it comes to investing. The more informed we are, the better equipped we'll be to make sound investment decisions and manage risks effectively. Investing is a marathon, not a sprint. It's about building wealth gradually over time, not chasing quick profits. Patience is key. Think of it like planting a tree. It takes time to grow and bear fruit. Avoid getting caught up in market hype or making impulsive decisions based on short-term fluctuations. Instead, focus on the long-term potential of your investments. Remember, time is our greatest ally in investing. The longer we stay invested, the more time our investments have to grow and compound. Remember, patience and discipline are essential virtues for successful long-term investing. By staying the course and focusing on our long-term goals, we can weather market storms and achieve financial freedom. Imagine you have 1 lakh rupees set aside, ready to invest in the stock market. This is a significant amount, and naturally you want to make the most of it while minimizing potential losses. Rather than putting all your money into a single stock, you decide to diversify. You split your investment into 4 equal parts, allocating 25,000 rupees each to 4 different stocks, each from a different sector: technology, healthcare, consumer goods, and energy. This approach spreads your risk and gives you exposure to multiple industries. By diversifying, you protect yourself from the risk of one sector underperforming. If technology stocks take a hit, your investments in healthcare, consumer goods, or energy might still perform well, helping to balance out your overall returns. Another important risk management tool is the stop-loss order. Suppose you purchase a stock at 50 rupees per share and set a stop-loss at 45 rupees. This means you're prepared to accept a small loss if things don't go as planned. If the stock price falls to 45, your stop-loss order automatically sells your shares, limiting your loss to just 5 rupees per share. This helps you avoid larger losses and keeps your emotions in check during market downturns. Risk management also means doing your homework. By carefully researching companies, you might discover a promising startup with strong growth potential and a solid business model. You choose to invest early and hold on to your shares for the long term, understanding that markets can be volatile in the short run, but often reward patience and discipline over time. As the company grows and its profits rise, your investment appreciates significantly. By managing risk wisely, you give yourself the best chance to achieve steady, long-term financial growth.